Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at Options Play. And today we're here to talk about a more advanced topic, which is selling vertical credit spreads. This is a strategy that's very popular amongst more experienced and especially professional traders because it's one of the few strategies that really is what we consider a very forgiving strategy, meaning you could be correct on the directional view, you can have a neutral directional view, and you can actually get the directional view incorrect and still be profitable on this strategy. So it's a strategy that's favored by a lot of traders, but the trade-off with this type of strategy is that it does have a negative risk to reward ratio, meaning what you're risking is going to be larger than what you can potentially make. So today, what we want to do is we want to break down the strategy so that for those of you that are new can understand how it's constructed, how do you trade these types of strategies, and more importantly, how do you manage these strategies once you're in them. And for those of you that have some experience options trading these types of strategies, we want to review what are the best practices. How do you select expiration dates, strike prices, so that you can maximize your income and focus on reducing risk whenever you're selling one of these types of credit spreads. So let's go ahead and get started. Now, before we do, what we're going to discuss here today is purely for education or demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. And just a quick reminder, we just did a monthly market analysis session last Monday with Steve Sosnick from Interactive Brokers. A lot of you were able to attend that session. I look forward to actually hosting another one here in December. We're going to be doing one on December 7th. I'll remind everyone before we reach those dates, we'll send out registration links as well. So just remember that for those of you that are looking for some content and helping you better understand the current market environment and how to navigate these current volatile times, these sessions are designed to give you a better understanding of the different sectors that are currently moving and how market strategists like Steve and myself are currently playing the current volatility and the market outlooks that we may have. So look forward to having you guys here for that session. But the primary thing that we want to cover here today is to help investors understand how can you find and trade the most optimal credit spreads. So today we'll talk about what credit spreads are and also how to find the most optimal one for your portfolio. So I apologize. I seem to be missing a slide with the agenda, but I'll walk everyone through the agenda here in 1 second. But today what I want to share with you are, as a strategist, what I typically look for when I'm selling a credit spread. Because again, this is a strategy that's very popular, but I tend to find a lot of retail investors are utilizing the strategy in the incorrect way and actually risking a lot more money than they really need to and optimizing for the wrong thing. So today, what I really want to make sure everyone understands are what are the best practices for this one strategy. Now, before we get started, I just want to do a quick survey here. How many of you in this room, and you can click on the chat button at the bottom of your screen, if you can bring up your chat button, how many of you have traded credit spreads before? Please type 1 into the chat window if you have traded credit spreads, and please type 2 if you have never traded a credit spread before. Okay, I see a lot of ones, quite a few twos, but it seems like ones are outpacing twos. You know, a lot of you have traded, but then a good chunk of you have never traded a credit spread before. Okay, so for those of you that have traded credit spreads, this is really making sure that you understand what are the most optimal uses of credit spreads, both in terms of entry as well as exits. For those of you that have never traded a credit spread, hopefully today gives you an understanding as to how you can utilize this type of strategy and why you might want to utilize this type of strategy and why it's one of the most popular trading strategies by experienced and professional investors. And then I will try to go through as many examples as possible to show you how you can utilize a tool like Options Play to analyze and ultimately trade these types of strategies. So first off, let's talk about when should you sell credit spread. So, it's one thing to break down the strategy, but it's another thing to just identify when should you execute these types of trades. And from my perspective, it's pretty clear as to when are the most optimal times to enter a credit spread. This is first of all near a support or resistance level. So whenever you identify a stock that maybe is trading near a support level, maybe on this particular case, this is Royal Bank of Canada. As you can see, you found a bit of support here around 92. When the stock approaches those resistance levels, support levels, those are your optimal times to enter a credit spread. Effectively, what you're looking for are when stocks are going to reverse in one direction to the next. Whenever you're able to identify a reversal in direction, those are opportune times to sell a credit spread. So for example, right now, I would say that you are approaching a resistance level around 102, right? So you have approaching a resistance level, a prior resistance at 102. If you feel that the stock is going to bounce lower here, maybe you have confirmation from a technical indicator that's starting to roll over, and you say that you have a conjunction of a resistance level and an oversold level, or the fact that it's in a trading range and it's near the upper bound of the range. This is really the most ideal condition to sell a credit spread. Whenever you find that the stock is reversing from one direction to the next, that is the most ideal time to sell a credit spread. Okay, so let's actually break this down. Let's look at stocks that are either approaching a resistance level like this, or perhaps approaching a support level, and looking at two different examples, one with a bullish example and one with a bearish example, as to how you can utilize this type of strategy to take advantage of stocks that you believe are going to reverse from one direction to the next. Now, does that make sense to everyone as to when you want to utilize credit spreads? Please type 3 into the chat window if that makes sense to you as to when you want to consider thinking about using a credit spread. Okay, I see a lot of 3s. Perfect. So let's talk about let's first talk about a bullish one. So a stock that is maybe currently moving lower that you think is going to now reverse that and start moving higher. So I'm going to use a symbol or a sector that I think for a lot of Canadian investors for quite some time, there's a lot of hype in 2017 about marijuana stocks. That slowly died down quite a bit over the last couple of years. And with the US election last week, this has come back to life as 5 states that had it on the ballot on U.S. elections, all 7 propositions were passed. So all 5 states voted to legalize marijuana in some way, shape, or form, whether it's recreational or medicinal. So there is certainly a shift in momentum that I think a lot of marijuana stock investors have looked at. And we saw some extreme moves. Aurora Cannabis went from well below $4 or so to over $14, almost a 300% return in a couple of days, quickly faded most of those gains back. And, maybe you think that the market went too far too fast, gave back most of its gains, and now you think the markets are going to start resuming that move higher. I'm not saying that this is a stock that's going to reverse higher, but I'm saying that this is the type of opportunity that you might be looking for, or similar types of opportunity that you might be seeing in the markets, and how to take advantage of this type of move using a credit spread. So to understand a credit spread, the first thing we need to do is break it down into its fundamental building blocks. So let's say Aurora Cannabis, right? The first thing I would say is that at the very least, based on the fundamentals, based on the price action, I would certainly say that I at least have a neutral view, that maybe it's at least just going to move sideways here. In an ideal condition, I think the stock's going to go higher, but if it moves sideways, I can still be profitable using the strategy. And that's what I'm going to show you, is why this credit spread is so powerful and so popular amongst traders, is because if you get the direction right, meaning it moves higher, you make money. But if it moves sideways, you can also make some money here in this particular case. Now, I just realized that I have the wrong chart here for Aurora. I have the US based Aurora Cannabis here. Give me 1 second. I'm just going to update this really quickly because I want to make sure I have the right strike prices up here when you're looking at this type of chart. So give me 1 second. I'm going to have the correct. Okay, let's take a look at this. Let's look at the TSX version. So this is the same chart, but in US, instead of in USD, it's in Canadian dollars. We had the big move in Aurora from roughly a little, about $6 or so, all the way up to about 18, crashed all the way back down to about $9. And right now it's hovering just above that $9 level. And we zoom in a little bit, we can see that $9 level corresponds to that 21-day moving average. That's the moving average line that I have here. And the idea is that this is going to get supported by that rising moving average, either slowly moving higher or rising higher, substantially higher here, as a lot of investors are currently looking at a name like Aurora Cannabis. So what I want to do is I want to show you how you can take advantage of a credit spread. So the first thing that you want to do with a credit spread is you want to sell a put option on a stock that you think is going to reverse from moving lower to going higher. And selling a put option is a simple option strategy that allows you to take advantage as long as the stock doesn't drop below a certain price. So when I sell a $9 put, the goal for that type of strategy is for the stock to stay above $9. 9 Canadian, that is. So in this particular case, let's say I sell a $9 put, and in this particular case, I collect a $1.35 credit. So I sell a $9 put, collect a $1.35. But the challenge here is the fact that when you sell a put option, you need to post quite a bit of cash, if not margin, in order to sell that $9 put. And you take on the risk that if the stock drops significantly, you are putting a significant amount of capital at risk. It's the same risk that you're putting in if, let's say, you put a limit order to buy the stock at $9. When you sell a put, you're obligated to do the same thing as if you placed a limit order to buy the stock at $9. So if you buy the stock at $9 and the stock plummets, the more the stock goes lower, the more you lose, all the way down to zero. So this is one of the challenges with selling a put option, is the fact that when you sell a put, you're taking on substantial risk. And in a name like Aurora Cannabis, the stock can move substantially lower because it is, at the end of the day, a volatile stock. And we have seen some significant moves to the downside in a relatively short amount of time recently. So it's possible that the stock continues to move lower, and you want to make sure that you reduce your risk. And that's where a credit spread comes into play. What I'm doing here is I'm selling the $9 put, collecting $1.35, but because I don't want to take on the risk of the stock plummeting and risking $9 a share, what I do is I buy a $7 put option. And let's say in this particular case, I pay 45 cents for that $7 put option. Now, what happens is instead of collecting $1.35, I pay 45 cents in addition to that. So now what I'm collecting is just 90 cents. 90 cents on a $9 put is roughly 10% of the underlying stock's value that I'm collecting here in this credit spread. But before, when I sell a $9 put, I'm taking on $900 worth of risk per contract, because if the stock goes to zero, I lose $900. Because I don't want to take on that type of risk, what I'm doing is I'm buying that $7 put. And what that does is it locks in the most I can lose. In this particular case, what I'm doing here is the vertical width is $2, meaning the distance between the two strikes, the distance between the strike that I sell and the strike that I buy is $2. And when you sell a credit spread, the amount that you receive on the trade gives you a sense for how much you can potentially make versus how much money you can potentially lose. And the maximum is the $2 that the vertical width is. So whatever you collect in reward in this particular case, because I'm collecting 90 cents, that translates to $90 per contract. The rest of the $2, the $1.10, is my max risk. And the two, when you add these two together, that adds up to the $200 of the vertical width, which is 2 times 100, the 100 multiplier that you have for each contract. So whatever you can potentially make on a credit spread, the rest of it is going to be your max risk. And the goal here is to collect premium the same way that you would collect premium if you sold a put, but do so in a way so that you're not risking $900 in a contract if you just sold the $9 put. Here, I'm only risking $110, a small fraction of what I would be risking if I sold the $9 put naked. So in this particular case, what I'm doing is I'm trading off a little bit of income here. Instead of collecting $135 in income, I'm now only collecting $90 in income, but I've traded off $900 worth of risk for just $110 worth of risk. And that's the goal of selling a credit spread. And in this particular case, the reason that many investors like this type of strategy is because the strategy will profit if the stock significantly moves higher. It will also profit if the stock just moves sideways. If the stock stays above $9, you keep the $90 that you sold the credit spread for. But if the stock moves lower, okay, meaning I got the direction wrong, you can actually still be profitable on this trade because the strategy is actually profitable as long as the stock stays above $8.10, which is the $9 put minus the 90 cents that you collected. So your break-even price is $8.10. So the stock can actually move, in this particular case, up to about 9% lower before you actually lose any money on this trade. So, there's no other strategy in the world where you can get the direction wrong by that amount and still be profitable on the trade, except for a trade like a put credit spread or credit spread in general. That's why we say it's a very forgiving strategy, because you can get the direction right. You can get the direction neutral, meaning the stock doesn't move either way. You can still be profitable. And even if the stock moves a little bit against you, you can still be profitable. The only time you lose money is if the stock makes a big move to the downside. And if that happens, your max risk is limited. In this particular case, substantially smaller than if you didn't buy that $7 put. If you just sold the $9 put and the stock dropped, the more the stock drops, the more you lose. Here, the most you can lose is that $110 per contract. So that's the fundamental starting point or the building blocks of a credit spread. Now, I see a couple of questions here as far as, what type of expiration dates. That's exactly what we'll get to here in 1 second. But why when does the maximum risk happen? The maximum risk happens when the stock drops below $7. So if the stock dropped below $7, that's when you lose your maximum risk, okay? And there's a couple of questions about how to select expiration dates and optimal vertical widths. We're going to talk about that here in 1 second. But I first just want to make sure everyone understands the construction of a credit spread. As you sell a put that's close to the current price of the stock, you try to collect some income and you try to maximize an income. And what you're doing is you're buying a lower put simply so that you're reducing your risk from, in this particular case, if you just sold the $9 put naked, you would be risking $900. Here, by buying that $7 put, what you're doing is you're defining your risk so that instead of risking $900, you're only risking $110. Does that make sense to everyone? Please type 4 into the chat window if that makes sense to you. Okay, and I'll just show this to you in options play to make this a little easier to understand. We'll look at ACB here using options play. This is the tool that everyone has access to free of charge here at with TMX's access to options play. So I want to take a look at this in terms of the tool itself. So give me 1 second to load this tool here. Aurora Cannabis. Whoops. Okay, so Aurora Cannabis is currently trading at $9.15. So what I want to do is I want to show this to you where I used, and I'm going to use the strategy constructor here using options play. I can sell, I can go to bullish. I'm going to do short put vertical, and I'm going to select selling the $9 put and buy back the $7 put. And as you can see, that currently collects about 90 cents on a $2 wide credit spread. $2 wide because it's the distance between the two strikes. And we'll talk a little bit about how to select expiration dates and strike prices, but I just wanted to show you here, as you can see here, your maximum reward is $90. Your maximum risk is $110 because whatever you collect, the remaining of the vertical spread, that is your maximum risk. And what you're trying to do is you're trying to trade off collecting as much premium as possible while minimizing your risk as much as possible, okay? So, but generally what you're going to find is you're going to sell an at the money put or call. And what you're trying to do is you're buying back a put or call that's out of the money. That's, usually about a 20 to 25 delta is a good starting point on these types of credit spreads when you're buying that out of the money put or call. And that's going to help you reduce the overall risk on your trade here, okay? So that's just an example here of a bullish strategy. The next one I want to show you is a bearish strategy. And again, this is not to say anything about this specific stock, but I was just looking at the Royal Bank of Canada just earlier today. It is approaching a level that the stock stalled at here back in late August. The stock rallied up to this 102 level, spent a couple of days there, and quickly declined. We're quickly approaching that same level here. So perhaps you're thinking to yourself that you're going to get another rebound at this particular level. So Royal Bank of Canada earlier today was trading around 101.5. So what I'm going to do here is I'm going to walk you through the same type of strategy. Now, as an options investor, one of the things that you can do if you think that the stock is going to reverse lower, you can buy put options. You can also sell a call option. Those are your two choices. Now, if you buy a put option, the stock needs to drop in order for you to be profitable. It actually has to drop by a significant amount in order for you to be profitable. But it's possible that you think the stock's just going to trade sideways or move a little bit lower. Maybe you don't think the stock's going to make a big move to the downside. That's when you might want to sell a call option. So let's say I sell a 102 call option. Let's say I collect $1.85 on this call option. Now, the challenge here when you're selling a naked call like this is that you're truly taking on unlimited risk. Meaning, what if you're wrong and the stock breaks above that resistance level and keeps going? Now, when you sell a call option, the further the stock goes, the more money you lose. So what you want to do is you want to make sure that you take these types of positions, but you don't necessarily want to take on unlimited risk. So what we do here is just like the put side, on the call side, what we do is we buy an out of the money call option here. Let's say I buy a 105 call option and it cost me 70 cents. So I collected 185 by selling the 102s, and I'm paying 70 cents to buy the 105s. So net, what I'm now collecting, instead of $1.85, I'm now collecting only $1.15. And what I do is I take a look at the distance between the two strikes. So the difference between 102 and 105 is $3. So if I'm collecting $1.15 on a $3 wide credit spread, how much am I collecting of the width here? So what I'm doing is I'm collecting 115, and because it's a $3 wide credit spread, that means my maximum risk on this trade is the remaining amount of the $3, which is $1.85 or $185 per contract. So what we typically measure when we sell these credit spreads is how much income are we collecting as a percentage of the width, because again, the two always add up to the total width. So in this particular case, this adds up to $300. So what you're doing here is you're trying to maximize your reward as much as possible, because the more reward you have, the lower the risk, right? And the goal here is to try to turn this in your favor as much as possible. The more premium you can collect, the less risk that you're taking. And we always measure it in terms of the percentage of the vertical width. Here, we're collecting 38% of the width. In the previous example, because we collected 90 cents on a $2 wide credit spread, that's actually 45% of the vertical width here. Now, we generally tend to find that 40% is pushing it. Rarely are you able to find something like 45%. The only reason we were able to find something like 45% here on ACB is because ACB's implied volatility right now is through the roof. Volatility on this particular stock is extremely high, so that's why we were able to find something that's on the extreme level. But what I found here in Royal Bank of Canada, that's much more in line with what you're likely going to find from a day-to-day perspective, is somewhere in the 35, 38, 40% is really the maximum that you'll generally be able to collect. Now, when you are risking 30, when you're risking 38% of the vertical, or when you're collecting 38% of the vertical width, that means you have a risk of about 62% of the vertical width. And again, the goal is to maximize this, because that's going to push this number down. And when you're able to maximize the potential reward as much as possible and reduce your risk as much as possible, that's when you start putting the probabilities of these types of trades in your favor. Now, what I'm doing here is I'm collecting $1.15 on a 102, 105 call spread. What that means is that if the stock was to drop, I'm going to keep the $115, the maximum credit that I could receive on this spread. If the stock moves sideways, let's say just stays at 101.5 by expiration, I also collect the $115. Now, what if I get this wrong? What if the stock goes up to 102.5, right? As you can see here, it did go all the way up to just shy of 103 last time. So what if the stock does move a little bit higher, but not too much, a little bit higher? How much money can I make? The reality is that this strategy, is actually profitable as long as the stock stays below 103.15 or lower. So that's all the way up here. And the reason for that is because what I have is a buffer of about $1.15 above the 102 strike price. So if the stock goes up by $1.15 above the 102 strike price, that's the buffer that I have. So even if the stock goes a little higher, I can still be profitable. And that's why this is one of the more, I would say, favorable strategies that a lot of traders like, because in scenarios 1, scenario 2, and scenario 3, all three strategies make money. The only time I lose money is if the stock takes a big move to the upside. So I basically get the direction completely wrong. That's when I'm risking $185. But in the other three scenarios, if the stock goes a little bit higher, if it moves sideways, or if it moves substantially lower, I can be profitable on that trade. And this is, again, why we call it a very forgiving strategy, and why a lot of retail investors tend to gravitate towards this strategy, because they tend to think that you can make more money there's more probability of making money than the other strategies. But the flip side, the one thing that you must understand is that even though this is a high probability of profit trade, because out of the 4 scenarios, 3 of them you're profitable, a lot of people say, well, okay, I want that. I want to be able to make money 3 out of 4 possibilities. But the downside, the trade-off that you're making, is that you are risking more money than you are making. So meaning in that one time that you lose money, you're going to lose more than what you're maybe making on the previous 2 trades. So it's not one is better than the other. It's just important to understand what your risk reward ratio and what trade-offs you're making when you're seeking these higher probability trades. I tend to find a lot of retail investors, they gravitate towards high probability trades. They say to themselves, if I win 80% of the time, that's all I need. But they forget that the 20% of the time that they lose, they could blow up more than what they win the other 80% of the time. So don't just focus on probability. You also have to look at the risk reward of each strategy. And I'll show you that here in, using the options play tool here. Let's look at Royal Bank of Canada. I'm going to set up exactly the trade that I want to show you here. We'll go to the strategy constructor. We'll select a bearish strategy, and we're going to sell a call vertical here, the strategy that we just talked about. And let's say we sell this 102, 105. And as you can see here, I'm collecting. So the spreads of the prices have moved a little bit, actually a little bit more in our favor here. I'm collecting $1.25 now and only risking $1.75. So that actually 10 cents that I made actually substantially increases my probability of profit, because now I get another 10-cent buffer. I can be profitable in more scenarios in this particular case. But I tend to find that sometimes retail traders, what they'll do is they'll do something more like this. Now, the 102, 105, as you can see, has a 62% chance of being profitable, right? And that certainly doesn't sound bad to be able to make money 62% of the time. But I tend to find that some investors, they seek some crazy stuff. They'll go to the 105, 110s, and they'll say this has 77% chance. Doesn't 77% chance of making money sound better than 62? But as you can see here, for every $60 in potential income that I make on the strategy, I'm risking $440. How much is that in terms of the amount of money that I can potentially make? 440 into 6 is 7 times more risk than the reward that I'm making. That means, okay, let's just say I win 77% of the time. That's 3 out of 4 times. So let's say 3 times I make $60. So I make $60 each time, 3 times in a row. And the 4th time I lose $440. What does that outcome come out to be in the long run? Do I make money, or do I make money, or do I lose money in the long run? If 3 out of 4 trades I make money, but I make $60, but the one trade that I lose $440. Do I make money, or do I lose money in the long run? Please type it into the chat window. I think everyone knows the answer to the question. So what's better? Making money 62% of the time, or making money 77% of the time? The answer is, it doesn't matter. You have to also look at what your risk to reward ratio here. So this is 62% of the time, right? So that's 6 out of 10 times I make money. But if I make $125 6 out of the 10 times and lose 175 the other 4 out of 5 times, that is much closer to being breaking even. The other one wasn't even close. So that's why I think as a retail investor, it's so important that you don't just focus on this one number. I see too many investors focus just on probability of profit and not enough on how much is the risk to reward that I'm taking on. And if I actually win in this particular case 3 out of 4 times, but lose that one time, do I wipe out all of the gains from the last 3 trades, or am I able to be profitable in the long run? That's really the math that you want to do, and that's what the options play score is designed to do. It's doing that math for you, saying that if you won 6 out of 10 times making $125 and you lost $175 the other 4 out of 10 times, do you come out ahead? The options play score gives you that sense of whether you're coming out ahead or behind on that particular trade. Now, for example, if you did the 105, 110s, guess what? The options play score is actually going to be worse. Now, this is assuming a normal distribution, but if we look at what is potentially the real possibilities here, as you can see, the options play score gets lower here. It's actually doing this type of math in the background, saying if you won 3 out of 4 times $60, but you lost $440 the other times, what does your outcome come out to be? The options play score is doing that type of math for you so that you can see, in the long run, are you coming out ahead or are you coming out behind? That's what the options play score is actually doing in the background. So that's why I wanted to make sure everyone understands, what you really want to focus on when you're using these types of strategies. Don't just focus on probability, focus on if I win, this many times and I lose this many times, what is my total outcome in the long run? Okay, does that make sense, everyone? Please type 5 into the chat window if that makes sense to you. Perfect. Okay, so now let's talk a little bit. Let's first of all review the strategy itself. Again, it's what we call a very forgiving directional strategy. And you can use it when you have a neutral or a mild directional view. So if you think the stock's going to reverse, or if you think the stock's going to stay put, even if you think the stock's going to move just a little bit against you, you can use this strategy because it's a very forgiving strategy. And generally, it's best when you expect a neutral or small directional move. And the reason I say that is because if you do believe the stock is going to make a big move to the downside, right? Maybe you think that the stock is going to drop just like it did here before, right? You think the stock's going to make a big move. Well, guess what? Yes, you can make money selling a credit spread, but you can make more money buying a put option. And that is the fundamental difference as to when should you sell a credit spread versus when should you buy a put option. Because here, if the stock does plummet down to, let's say, into the 90s, right, into the low 90s, high 80s, no matter how far the stock goes, even if the stock goes to zero, the most you're going to make is $115, right? That's not a lot of money for betting the stock's going to move all the way down. If you bought a put option and the stock went from 101 down to $80, you could be making thousands of dollars. And that's really why it's so important to understand, do I think the stock's just going to reverse lower, or do I think the stock's going to make a big move to the downside? Because you then have to decide, should I sell a credit spread or should I buy a put option? And that is a very important distinction here. So that's why here at Options Play, we always want to make sure that you understand what your options are. So we talked about selling this credit spread here, right? But what if you can also consider buying a put option? As you can see here, if the stock went from 101, right, down to, let's say, I don't know, into 95, even $95, which is down here, which is where it was trading just a couple of weeks ago, right? If it gets down to $95 here, you're risking $175 to make $125. That's not a terrible risk to reward ratio. But here I'm risking $168, which is roughly the exact same amount that I'm making selling the credit spread. But if the stock gets down to $95, how much money do I make on the put option? I make almost triple the profit that I would if I sold the credit spread. So this is really where, as you start to learn more about these strategies, you want to make sure you start combining them and understanding them, because it's going to help you maximize your profit. Because the two, as you can see, the two strategies, buying the put and selling the credit spread, have almost identical risk. So if you're wrong on this trade, you're risking the same amount. But if you get the direction right, the two are very different in terms of what your potential rewards are, right? Now, however, if the stock doesn't move lower, right? Let's say the stock just stays where it is. Guess what? If you bought the put option, you would lose $168 versus if you sold the credit spread, you would make $125. And this is really why I always encourage investors, especially if you're new and you're learning these strategies, and maybe you're not 100% sure which strategy you should deploy at what time. Options Play allows you to put any two strategies side by side. Should you buy that put or should you sell that call? Should you sell the call spread or should you buy a debit spread? The answer is put the two side by side, and Options Play can help you answer those questions. It'll help you understand, number one, how much does the risk, how much does the risk line up with each other? In this particular case, the two are almost identical in terms of risk. But as you can see, how much money you can make heavily depends on where you think Royal Bank of Canada will be by December 18th. If you think the stock's going to be where it is, it's very clear that you should sell the credit spread. If you think the stock's going to move lower, it depends on how much lower you think the stock's going to move. If you think it's going to go down to, 99, as you can see, still the credit spread is better. If you think it's going to go down to 97.5, the credit spread's still better. But if you think it's going to go down to 95, it's very clear that at that point, you're much better off buying that put option. And maybe you're going to say to yourself, I definitely think the stock's going to get down to 95. Then it's without question that to take on the same amount of risk, I would rather get paid a $300 profit for my $170 risk than get paid a $125 profit for the same amount of risk, right? So this is how you can make your own decisions as to which is best suited for you. And as you can see, if the stock gets down to 91, which is where it was on December 30th, that's about 2 weeks ago. If the stock gets back down to 91, the put option will make you $700 profit, while the credit spread is still only going to make you $125 because the credit spread has limited reward. When you buy a put option, the more the stock goes lower, the more money you make. Okay, so this is how you can utilize this tool to help you make these decisions. Now, these types of credit spreads are better in higher implied volatility environments. So for those of you that are using IV rank, usually above 30 is usually a good indication of a higher volatility environment. But they also, generally speaking, from a directional perspective, are best near extreme overbought or oversold conditions. So depending on the type of technical indicator that you're using, whether you're using stochastics or MACD or whatever it is, whether you're using RSI, doesn't matter which one you use. When they're near extreme overbought, oversold conditions, those are your most ideal times to enter a credit spread. When the momentum is reversing, when it's shifting from moving higher to moving lower, or if it's moving lower to moving higher. Whenever you see that momentum shift, those are your ideal times to sell a credit spread. You can also do them near double tops, double bottoms, support or resistance levels. They're all a similar technical analysis reversal points, right? It's just a matter of whether you're using a price action to identify those reversals, or if you're using a momentum indicator to determine those reversals. Those are the opportunities to sell these credit spreads. And again, you do not want to use these credit spreads when you expect a large and fast move, because if you expect a large and fast move, you're better off buying a call or buying a put option. You're not risking much more typically by buying that call or put, but you can potentially make a lot more if the stock does make that big move. Okay, does that make sense, everyone? Please type 6 into the chat window. And I know I'm covering a lot of things, and if this is new to you, or if you feel like I'm going too fast, again, we will have a Q&A session here in a few minutes to help you answer any remaining questions. But for those of you that, if this is your first time, this is recorded so that you can watch it later with the slides and make sure you understand this fully before you execute any of these strategies in your portfolio. So a couple of questions before about these types of trades. So again, I want to clarify. A lot of people ask, should I use a credit spread or should I use a debit spread? And the answer is that the two are just trade-offs. One is not better than the other. And what we were just talking about before is the trade-off is really between these two things, probability and risk to reward. Whenever you have a strategy that's high probability, like we do with credit spreads, that's going to come with poor risk to reward. So it's important to understand the characteristics. So when you sell a credit spread, you're going to see 67% of your time, you're going to see roughly 65% of your trades are going to be winners. But for every trade that you make, you're roughly risking double the amount of potential reward. So that's the trade-off that you're making. You have high probability, you're going to get poor risk reward. On the flip side, a lot of times people will ask me, why would anyone trade debit spreads? It has such low probability of winners, 30, 40%. The answer is, the risk to reward ratio is great because you're going to risk a relatively small amount if you're wrong. And if you're right, you're going to be able to make a much larger amount. So the two offset each other. So it's really important for investors. And this has nothing to do with the lesson that we're learning here today. Any type of trading. A lot of people say, why don't you do this? Why don't you do that? Almost 9 out of 10 times the answer is because understand the trade-off. Just because you have one really good thing over here probably means you have a really bad thing over here that you're probably missing, or vice versa. If you have something that's really good over here, then you're probably missing something that's bad over here. So always ask yourself whenever you're looking at a strategy, right? If something sounds too good to be true, either high probability or really good risk reward, ask yourself, what's the other side of this equation look like? Chances are you're always going to, well, it's not even chances are, you're definitely always going to have some type of trade-off. And it's important to understand what the trade-off is and the fact that you need to look at both in order to make a decision as to whether the strategy you're about to trade makes sense for you. So let's talk a little bit about the optimal credit spread. So, a lot of questions before about choosing expiration dates and strike prices. So let's discuss that a little bit. Whenever we're selling credit spreads, the optimal expiration is usually 30 to 45 days from expiration. That's the sweet spot when it comes to selling credit spreads. We always want to sell an at the money call or put, which is roughly a 50 delta. And then we try to buy back a 25 delta call or put. So if the stock is currently trading at $100, you would either sell a $100 call or $100 put. And then if it's a call spread, what you're trying to choose when we say a 25 delta, what that means is that you're trying to pick a strike price where there's only a 25% chance that the stock is going to be above that price. So a 25 delta or 25% probability might be something like maybe a 110 strike price, meaning there's only a 25% chance that the stock will be above 110 at expiration. And on the flip side, if we choose, let's say, a 25 delta put option, 25 delta put option, then that might be, let's say, a $90 put, meaning what you're trying to choose is a strike price where there's only a 25% chance of the stock going below $90. So delta is always what we use to help us pick our strike prices. And when you use this type of method to select a strike price, what you're going to find is that the credit that you receive is usually going to be roughly 1/3 of the distance between the two strikes. So in this example here before, right, when I was talking about a 100, let's say I sold the $190 put option. So I sold the $100 put and I bought the $90 put option. This has a width of $10. Right? $10 width. So what that means is that what I'm trying to collect on a $10 wide credit spread is usually about $3.33. If I'm collecting $3.33, that means I'm risking $6.67. That is what we call the optimal credit spread. Now, if you're able to find a credit spread that collects, let's say, $3.50 on a $10 wide credit spread, now what you found is a strategy that's better than optimal. Those are the ones that you want to seek, right? If you're able to collect more than 33% of the width, then what you're doing is you're collecting more than what the optimal credit spread is going to typically has. And what that also means is that you're reducing the risk of the overall trade. That's what you're trying to select when you're selling these types of credit spreads. And these types of credit spreads will usually have about 60 to 70% winners, and they'll usually risk about $200 for every $100 in potential reward. So let's just talk a little bit about managing these trades, because I get a lot of questions about, once you're in a credit spread, how do you determine when to get out? And with a credit spread, there are 3 potential triggers to exit credit spread. So once you're in a credit spread, there are 3 triggers. Whichever one of these three triggers triggers first, that is your signal to get out of the trade, okay? The first one is if you reach 14 to 21 days to expiration. So 2 to 3 weeks from expiration. If the credit spread reaches 2 to 3 weeks from expiration, it's time to get out. Meaning this is not the type of trade that you want to hold into expiration. The second trigger is if you make 50% of the max gain. So if you can potentially, and I'll walk you through an example of this, but if you make 50% on the max gain, that's your second trigger to potentially get out. And the last trigger to get out is if you lose 100% of the max gain. So here's an example here. Let's say I sell a $5 wide credit spread, and let's say for that credit spread, I'm collecting $2, right? So $5 wide credit spread, I'm collecting $2 for that. So my maximum profit here is $2. If the spread expires worthless, the most I can make is $2. So what you generally want to do is if the $2 credit spread reaches $1, right? So 50% of the max gain, once it reaches $1, it's time to take profits and get out of the trade. Now, that's if the trade goes in your favor. What if the trade goes against you, right? It's a $5 wide credit spread. You originally collected $2, but if the trade starts to go against you, you're going to see the value of that spread is going to increase. It's going to increase towards that $5 spread, the maximum loss on that trade. So if it goes from $2 to $4, which is 100% of the max gain, then it's time to get out of the trade at a loss. Now, if the trade does not hit criteria one, if it does not hit criteria one or criteria two first, but it reaches 14 to 21 days from expiration, basically without hitting your take profit level and without hitting your stop loss level, then now it's time to just get out regardless of whether you've made money or lost money at 14 to 21 days from expiration. That is the optimal strategy to exit a credit spread. Now, that covers what I wanted to share with you. And I generally tend to find that a lot of investors have a few questions here with this last spread, with this last slide. So what I'm gonna do is I'm gonna actually leave this slide up and open this up for Q&A, because again, I tend to find a lot of questions tend to arise out of this type of, this last slide. So I'm gonna leave this up and I'm gonna open this up for Q&A. If you have any questions regarding anything that we spoke about here, there's a chat window and there's a Q&A window. Please type your questions into the Q&A window and I will answer your questions out of the Q&A window. And I'll try to stay here for as long as I can to answer as many questions as I can do here for you guys. Okay, let's see. Wallace is saying, hi, Tony. Is the options play Canadian TMX edition going to provide the daily credit spread report just like the US edition? Wallace, that is something that we're currently working on. I don't have that just yet, but it is something that we are talking to the TMX about offering in 2021. It is not something that we currently have just yet. Can you trade the strategy in a registered account? So that is a question that I'm going to have to defer to someone here in Canada who has a registered account and can confirm whether you can or cannot trade this. If anyone has the answer to that, please. So Frank just said you cannot trade the strategy in a registered account. So it sounds like you can only trade this in a regular brokerage account. What happens if ACB goes to $7 before expiration, then goes back up to $9? So a great question. So the question was, in this particular case, let's say I sold, let's go back to ACB. The question was, what if I sold that credit spread and the stock went from $9 to $7 before expiration and went back to 9 by expiration? The answer is you would make the profit. So even if the stock goes to 0 before expiration, as long as it ends up above $8.10 by expiration, $8.10, it doesn't really matter what happens between now and expiration. As long as at expiration, the stock is above $8.10, you will be profitable on this trade. So, but the question is, if the stock goes all the way down to, let's say, $5, do you want to hold on to that and potentially lose the full $1.10, or would you want to cut your losses and move on? From my perspective, if the stock makes a big move to the downside, that probably means your original thesis of the stock staying above $9 is probably wrong. We would tend to cut our losses and move on. Now, that doesn't mean that you have to, right? Meaning if you want to hold on to it, or if you are confident in the stock will be back above $9 by expiration, then even if the stock goes to 0 and comes back above 9, you will still be profitable at expiration. Just to be sure, the idea is to never let the contract expire, correct? Yes. The answer, that's part of the reason that we don't want this to expire worthless, is because there are some very extreme, I would say, edge cases where it is possible to lose more money than the defined risk strategy. Meaning, if let's say if you hold this all the way through expiration and the stock lands in between the two strike prices, and you're thinking to yourself, I don't need to exercise my long put, but maybe something happens over the weekend and the stock opens up next week at $5, and the person who's short the put is the person who's long the $9 put chose to exercise it, but you didn't choose to exercise your $7 put, then you could potentially be at a much larger loss. And to avoid that, it's very easy. Just don't hold these to expiration. Always close them 2 to 3 weeks out from expiration, and you will never, ever find yourself in that position. it is extremely, extremely rare, but we actually had an instance of this where a stock was halted in trading a couple of weeks ago here in the US. The stock closed at 320 or something, opened up at 220 the week after, and someone who had a credit spread held it to expiration, didn't think to check what happened on Friday afternoon, didn't exercise their long put, and the short put that they were in was exercised, and they ended up with a huge loss in their portfolio. Now, again, this is an extremely rare edge case. The stock halted, the person didn't bother to take a look at it. That is a possibility, but you can avoid it completely by not holding these to expiration. How do you calculate the 38.3%? Okay, so the question was, how did I calculate the 38.3% of the vertical width? And the answer is $1.15 divided by 3. So $1.15 is what I'm collecting. $3 is the width, which is the distance between these two strikes. So if you take $1.15 divided by $3, you get 38.3%. That's how I calculated that number. Rai is saying, Tony, the bell-shaped curve shown on options play is the implied volatility. No, the bell curve is showing you what is the expected trading range. Now, that is calculated from the implied volatility, but that in itself is not the implied volatility. I am still not clear when in time will I win or lose a reward or risk? When will my trade platform resolve the spread? So your profit and loss comes from when you close the trade. Just like when you buy a stock, right? Let's say you buy a $9 stock and the stock goes up to $12. When do you make your money? You make your money when you sell your stock for $12. So here's the same thing, right? If you sold something for $3 and the stock and the spread declines to $1, when do you make your money? You make your money when you buy back the thing for $1. That's when you make the $2 profit. So effectively what's happening here is, if let's say you sold something for $3, you're basically hoping that the value of that spread will go down. Now, if the value of that spread goes down and goes down from $3 to $2, $3 to $2 to $1 to 50 cents, you don't make your money until you say, okay, I want to get out of the trade and I buy back my spread. Let's say you buy it back at, let's say you buy it back at 50 cents. At that moment, that's when you make your $2.50 profit. No matter what happens in between, if the stock goes higher, lower, nothing matters in terms of what happens until you choose to exit your trade. That's when you make your money. Vice versa, if you sold something for $3 and the stock goes and the value of the option goes higher, let's say it goes to $5, nothing happens unless you choose to exit at $5. If let's say it goes up to $5 and then it plummets back down to 50 cents, then it doesn't matter the fact that it went all the way up to $5. The only thing that matters is to when you choose to get out of the trade, right? So if you choose to get out of the trade here, right, then in this particular case, you lose $2. Right? Because you chose to exit the trade. But if you held it in the stock then and the thing plummeted in value, it only matters as to when you exit the trade. So whether you may win or lose is dependent on how long you want to hold on to that trade for. Just like when you buy a stock, when you make your money on that stock is dependent on when you're ready to sell that stock. It's the same thing with any type of options trade as well. Is there earning strategies on options play? So, I don't know what you mean by is there earning strategies on options play. The strategies are all the same regardless of whether you're playing earnings or not. You can sell a credit spread going into earnings, or you can sell a credit spread when there's no earnings. The strategies are all the same. The question is, what do you want to trade the event for? So Aurora Cannabis doesn't report earnings here for 87 days. So in this particular case, this isn't an earnings play. But if Aurora was reporting earnings on Thursday, you could still sell the same option strategy. The strategy doesn't change itself. The question is just what do you want to trade? Do you want to trade this strategy on a stock that's reporting earnings next week? Or do you want to trade the strategy on a stock that doesn't report for another 80 days? That's up to you, but the strategies are the same. How can you identify whether a stock is going to make a big move? That's a great question, actually. And I would say that this is what most investors spend all of their time figuring out. Now, as a trader myself, I use technical analysis. So, looking at a name like, let's see, I think BMO may be a good one, right? So looking at a name like BMO, I was looking at this the other day, right? BMO has been trading below the $64 resistance for quite some time. Finally broke out above this $64 level. Let's zoom in a little here, right? So this is the $64 resistance level, 64 and a half. It broke out above that level, came back a little bit to test this support level. That is an opportunity to look for further confirmation. Now, when you get this type of pattern, that is a good pattern that's showing you that this is a stock that's breaking out above resistance level and is now going to continue moving higher. That is an example of how I use technical analysis to find stocks that I think are going to make a big move. So that's just an example of how you could utilize technical analysis to gather whether something was going to make a big move. When a stock breaks above resistance level, when a stock breaks below a support level, those are typically the type of patterns that technical analysts will use to try to find a stock that's going to make a big move. How can we find IV rank on Canadian markets? That's a great question, Rick. This is something that Options Play is actually working on. We're working with the TMX on capturing this type of data so that we can start publishing that in 2021. So very close to working on that with TMX. We don't have it just yet, but that's something that we're working on. Someone's asking, how do you check delta? So you can actually check delta by clicking on the blue share button for any strategy, and we have a thing called explain strategy in Greeks. So you can actually see the delta here on the Options Play platform, but we are actually in the process of adding delta to the drop-down menu. So you see how you have the strike price and the premium of the strike price? We're going to be adding to that the delta value next to it so that you can get the strike price, the strike price, the premium, and the delta all on your drop-down menu. Which trading platform is the best for Canadian trader to trade Canadian or U.S. credit spreads? So, I've been doing these sessions with Steve Sosnick with Interactive Brokers here all through the summer. We just did one last week. I still continue to say that Interactive Brokers, in my opinion, for those of you that are looking for low cost and the ability to trade multi-leg options, Interactive Brokers is one of the few brokers that really support both, in my opinion, and support it well in Canada. So that is one of the brokerage firms. It's not the only one. Questrade also does multi-leg options. So, I would look at Questrade and I would look at Interactive Brokers as two starting points for trading these types of strategies. I think that according to your rule, the stop loss should be at $2, 100% of the max profit. That is correct. So when you sell something for $2, right, 100% of that would be another $2. And that's why we say a $4 debit would be a 100% loss of the max gain. I know that sounds like a mouthful here, but basically, you're selling something for $2. Let's just call it $200 because that's how much you're actually collecting. When you make 50% of that, right? So when it goes from 200 to 100, that's time to take profits. That's 50% of the max gain, right? On the flip side, if the trade goes south, right, and starts to rise in value, 100%, then it goes from 200 to 400. That is a 100% gain. In terms of the max profit, that's when you want to cut your losses. So this is where you want to cut losses, and this is where you want to take profits. Barry is saying, hi, Tony, would it ever make sense to stack vertical credit spreads, i.e., with the second one further out of the money than the first credit spread to protect yourself in case the stock moves against you, or take the loss and move on? Would it make sense to stack a vertical credit spread? So I think what you're saying, and correct me if I'm wrong, I think what you're saying is that what if you sold this credit spread, right? You sold this credit spread. You think the stock is going to move you think the stocks are going to move a little bit lower, but instead the stock moves higher. I think what you're saying is, would you sell another higher out of the money credit spread then? Is that the question? So I'm just not sure what you mean by when you say stack the credit spread. I'm happy to answer that question, but I'm not 100% sure if I got your view correct. How do you exit the trade? So Tom, most brokerage firms will let you select your current position and click on close, and it'll automatically pre-fill the order ticket for you. But if you've never closed an options position before, we actually have a webinar just on that alone. I highly suggest that you watch that. Here, I'll post the link here to our YouTube channel. And because all of our videos are available there, and I want to make sure that everyone is able to access that for all of your needs with respect to options play. One second, let me make sure I get the right link to everyone. Okay, here we go. All right, I'm posting a link into the chat window. And that is a link to our YouTube channel. And all of our videos are there. And I highly recommend you to take a look at those videos. I do have one on managing orders. That is one that I think you should watch if you've never closed an options position before, because it's really important as to using understanding how to open and also close a trade, and your broker will be able to help you with that. So I highly recommend that if you've never traded an option before, if you've never placed an options trade, to go to your broker and have them walk you through entering an order and closing an order. It is different from each brokerage firm, so you do have to go to your brokerage firm to have them help you with that process. Alan is asking a great question. Why 14 to 21 days to expiration we shall exit? The answer is because a lot of investors, they learn about the theta decay. They learn that as the option gets closer and closer to expiration, that theta accelerates to the downside. And that's true, that you actually make more per day in the last few days or last week of expiration than you do in the previous few weeks. And, if we look at it a per day basis or a per week basis, you make more money as you get closer and closer to expiration. But the one thing that most investors fail to realize is also that gamma is what accelerates as you get closer to expiration. And when you're selling a credit spread, you're short gamma. Gamma is working against you if the trade goes south. So what we're trying to do is figure out where the acceleration in time decay versus the acceleration that you get in gamma. And at what point does the crossover starts to outweigh each other? And that crossover happens between 14 and 21 days, where yes, you're getting an acceleration in theta, but your gamma risk is rising at even a higher pace. So what you want to do is you want to make sure that you cut your losses, cut your trade at about 14 to 21 days, because the gamma risk starts to outweigh the acceleration that you're actually getting from theta decay. Credit spreads are not allowed in registered accounts. Thank you, Wallace. Prasad is saying, hi, Tony. In the current market conditions, this credit spread will work. What are the perfect conditions for credit and debit spreads? So the perfect conditions are based more on your directional view. The volatility certainly factors into it, but the volatility factor is still going to be relatively small compared to your directional view. Your directional view is always going to be the number one thing. The second part is going to be volatility. High volatility environments are better for credit spreads. Excuse me. Low volatility environments are better for debit spreads. The current environment that we are in, is actually on the lower side of volatility, of implied volatility. So it does tend to favor buying options a little bit more. So if you, but you still can find plenty of opportunities to sell credit spreads, because you have to look at the volatility of each individual name, right? So you look at ACB, you look at Aurora Cannabis, the implied volatility of that stock is through the roof, even though the implied volatility of the market is relatively low. So it doesn't matter that the implied volatility of the market is low. What you need to know is what the implied volatility of the stock that you're trading. Can we decide to exit as soon as 50% loss is attained on the maximum loss versus not waiting for the full loss? So first of all, we're not saying that you should ever wait for the full loss here. We're saying you should get out before the full loss. Now, you can get out at 50% loss instead of the 100% loss. And it's not a 100% loss. It's 100% of the max gain here, okay? So we're not saying wait for 100% loss. We're saying 100% of the max gain is when you want to cut your losses. Now, you can cut losses sooner, but what we tend to find is that many times you might be stopped out only to find yourself that if you had stayed into the trade, you would have actually still have been profitable. So that's why you don't want to cut your losses too quickly. Where can I find the recorded webinars? I just sent the link into the chat window with all of our YouTube channels. With our YouTube channel, that's where you can find all of our videos. Here's a question. Are you also looking at specific level of I volatility and ATR? Certainly not looking at ATR. That really has nothing to do with this. In terms of implied volatility, yes, but implied volatility is not one of the reasons to get into a credit spread. Implied volatility may be one of the reasons why you decide that the credit spread that you find is not optimal, but it's not a reason to get in. It may be a reason to not get it. And I think there's a distinct difference in that. Anil is saying, can we split two legs in between 2 to 3 days to see where the stock price goes up or down? Anil, if you are a very sophisticated trader and you understand and you can trade naked positions, naked calls and naked puts, and you feel comfortable being that tactical, by all means. But I tend to find that the average trader is not that sophisticated enough where they're willing to accept unlimited losses by breaking up those two legs. Because if you break up those two legs, you're taking on unlimited losses. So if you get that timing wrong and the stock shoots off, guess what? You can potentially be risking a lot more money than you had intended, which is why I would never recommend for 95% of retail traders to ever break up a credit spread like this. There's another question from someone saying, if my brokerage firm doesn't allow credit spreads in one shot, can we put the first leg in and then buy the second leg, same when we exit? The answer is yes, but you have execution risk there, right? So for number one, you must enter the long leg first and then enter the short leg, because you're not going to be able to do it the other way around. That's number one. Number two, you have that execution risk. What if one leg gets executed and the second leg never does? Now you've traded something completely different than what you originally intended on doing. So that's why I do encourage, if your brokerage firm doesn't offer it, I do encourage you to seek a brokerage firm that does. Hi, Tony. I find myself always making this mistake. Whenever I see a profit, let's say 40 to 50%, I will take the profit and get out. But last couple of times I will see a jump after I took profit. Right, I always tell investors, you can never go wrong taking profits. Yes, you're not all, and the reality is you're never going to be able to make the maximum profit. That's just the reality of trading. That's like you're never going to be able to buy the stock at the very bottom and sell the stock at the very top. If that's what you're shooting for, I guarantee you're not going to be able to make money in the long run. So, stick to the rules. If you have a set of rules like taking profit at 40, 50%, be happy with that. At the end of the day, you're never going to be able to maximize every single penny of every single trade. Any particular order in closing the legs? No, you want to enter and exit the trades as a single trade. You never want to break up the legs. Why is it better to exit at 100% loss instead of riding the trade hoping for a better outcome? Because 4 out of 5 times that you hope for a trade to come back, it won't come back. So you're better off saving that extra, even if it's $1, that $100 that you're saving in terms of that maximum loss, that goes a long way towards your next trade. If you can take $100 off of your next trade, that's going to go much further than hoping that the trade's going to come back. You have in most of these cases, once you've hit your stop loss trade, you usually have only about a 20% chance of even making any profit back. So 80% of the time, you're just going to lose the other rest of the trade. What does it mean when you have the logo of options play next to a trade? If you're referring to the options play logo next to a trade, so you see here the check mark, sometimes you see an options play logo, it comes down to the strategy checklist. So we have this strategy checklist. We checked a lot of different things. And as you can see, the last thing here is not green here. If the last one was green, meaning the spread and liquidity of this was high, then you would have gotten a green check mark. I'm sorry, an options play logo. Because they don't all turn green, that's why you get a green check mark here. Hi, Tony. Still not clear on when to implement selling credit spread versus buying a put. So Gregory, here's a good example. Here's selling the put credit spread. Here's buying a call, right? The two have, in this particular case, roughly the same amount of risk. Buying a call would cost me $116, I'm risking $116. Selling this credit spread, I'm risking $110. So the two are very close to each other, right? Now, if the stock stays the same, if the stock doesn't move, what's better? Selling the credit spread's better, right? Because if I bought a put, I'm sorry, buying the call option, I lose money. If the stock goes a little higher, which is better? Selling the credit spread's better. If the stock goes lower, which one's better? The credit spread's better. If the stock goes really higher, a lot higher, right? So let's say it goes back to $16. What's better? Buying that call option is better. So only if you think the stock's going to make a big move in the direction that you expect it to, that's the only time it's better to buy a call option or a put option. Every other time, you're better off selling that credit spread. So I hope that answered your question there. Is that a buy to close? Yes, buy to close would be a way to close your position. Will the market maker always look at the net price of the two legs, or is it filled separately? The market maker is looking at the net. I mean, at the end of the day, the market maker is a computer. It's not an actual person, right? So as far as what algorithms the computer is looking at, whether they're looking at individual legs, whether they're looking at the net price, it doesn't matter, right? The only thing that matters for you is the net price. It doesn't matter where one leg gets filled or not. So the only thing that really matters at the end of the day is that net price. Hi, Tony. What is the optimal theta percentage from delta to exit the trade? So Hossam, that's not a metric that I actually look at in terms of as a way to exit the trade per se. It's an interesting metric to look at, and I understand why someone might want to look at that, but I actually don't have any data to back up a specific threshold as to the ratio between theta to delta to exit a trade. I'll take a look into that research and hopefully perhaps provide some insights next time, but right now I don't have any insights into that. Do you have iron condor and options play? Can I compare that to another strategy? Absolutely. You can go to modify, go to the strategy constructor, click on neutral and select an iron condor. You absolutely can. You can compare any other strategy with an iron condor. Would you recommend not going over the $10 width between your spreads and continue to find the sweet spot? So the width is completely dependent on the stock price. So when you have a $9 stock, you're going to choose a lower spread. If you have a higher strike, let's say Shopify, right? A $900 stock, or I'm sorry, $1,200 stock, you're going to use a much wider you're going to use a much wider spread. So here I might sell the $1,200, $1,320. That's $120 wide spread. So how wide the spread is really a factor of the stock price. The smaller the stock price, the lower the spread. The higher the stock price, the wider the spread. What period of EMA and SMA do you use? Frank, great question. So, we use the 20, the 50, and the 200-day. Those are the ones that I use. Should you consider ex-dividend when using credit spreads? Paul, because we never hold these to expiration, generally speaking, it's not something that we generally factor. And especially, this is one of the other reasons why we avoid holding them into the last week. If you hold a short option going into last week, especially one that's near the current price of the stock, you do have early assignment risk. One of the ways to avoid that assignment risk, don't hold the trade going into the last 2 weeks. A question about, if there's any updates on Tasty Trade coming to Canada. If I'm not mistaken, I just had a seminar or a session with Tom Sosnoff last week. I think they already have a date on when they can take their Canadian exam. So right now they're shooting for Q1 of a launch in Tasty Works in Canada. Is Options Play planning to publish credit spread on I think that's something that I already answered there, Michelle. Yes, that is. We're working on that for 2021. Can you compare IB and for Canadian traders? If I'm not mistaken, you actually can't trade Canadian options on Thinkorswim in TD. You can only trade US. At IB, you can trade both US and Canadian options on that same platform. So I would say that that's the primary difference. People are saying that Questrade is more expensive than IB. I'm not here to comment as to like the cost here. That's up to you as far as which commission structure is best suited for you. IB might be better for small contracts, maybe a little bit more expensive on large number of contracts. So depending on your style of trading and the number of contracts, different brokers will give you different benefits. But both Questrade and Interactive Brokers and TD are 3 brokerage firms in Canada that offer at least multi-leg execution. Can you choose your strikes in the spreads? Yeah, you can choose your spread. You can choose your strikes all the time, no matter what strategy that you're choosing. You always have control over the spreads. I'm sorry, the strikes. Barry's saying yes with respect to stacking the spreads. So Barry, that's more of a risk management decision. And the question from Barry was, we were looking at, I think it was National Bank. No, we're looking at BMO. No, we're looking at Royal Bank of Canada, sorry. I'm looking at Royal Bank of Canada. And the question was, if I sold a credit spread here on Royal Bank of Canada and instead the stock keeps going higher, can I just sell another credit spread afterwards to try to, effectively recuperate some of your losses? The answer is yes, you can do that. But the question is, how many times can you keep doing that if the stock keeps going higher and higher and higher? Do you keep doing that over and over again and hope that, and the problem with this type of strategy is that when the stock does reverse, right, the strategy has a fixed amount that you can make. So if you lose 3 times, right, and the stock finally reverses lower, you're only making one of those trades back. And chances are what you lose here is much greater than the one that you're going to make back. So this is, generally speaking, not the best strategy for that, because again, when you're wrong, you're risking, in this particular case, $175. If you get it wrong again, maybe you're risking another $175. And the one time you get right, you make $125. So if you already lost, close to $350, and then you make $125 back, do you come out even? The answer is not even close. So that's why, generally speaking, when you're selling a credit spread, it doesn't make sense to stack your spreads. Is the strike of the sell leg always at the money? Yes. Generally speaking, you want to start with your research by selling the at the money strike price on a credit spread. Okay, I really have tried to get through as many questions as I have time for here. Let's see if I can do just one more. Can you give a webinar on technical indicators you use for a given trade? Sure, that's actually one of the things that we have planned here is technical analysis and doing a little bit more about that. But you can also come back to, this is what I do on the monthly market outlook sessions. Steve and I, we talk about technical levels, we talk about technical indicators, we talk about how we use technicals to determine a directional view. So I highly recommend for you to sign up for that. The next one is on December 7th at 12 p.m. That's a Monday, December 7th. So I really hope to see some of you there. So with that, thank you so much, everyone, for taking the time out here this afternoon. I hope that this was helpful in giving you a better understanding of, credit vertical spreads, how you can utilize it, what are the best practices, when should you use it, and how to avoid some of the common pitfalls of this type of strategy. So with that, what we'll do is we'll send out the recordings with the slides after we finish processing that here today so that you can watch this at your own pace, review it before you sell your next credit spread, and utilize the Options Play platform to analyze your spreads before you go ahead and place that trade. So with that, thank you so much. Have a great evening, and I'll see you guys here next time.